It's good to have you here. We're cranking through our all of our ways to buy companies with no money out of pocket. So I'm going to jump right in because we got a lot to cover. So I hope you're ready. And again, remember, these are all just things that are in your arsenal of stuff to use. One cool update: the software development team tells me that our software, which is on dealdone.io. So the Excel spreadsheet that you guys got that we walked through will be an official software with the ability to save scenarios and have users and all kinds of cool things. So you can save all your deals and it'll all be there. You guys are my beta group, so I'm super excited to have you give us feedback. So and please feel free to give us feedback. You can message me, you can talk with Deanna, you can post in the Facebook group, but let us know your experiences with that software because we will, the spreadsheet was designed to make it as easy as possible to analyze the deals. The software will make it even easier, plus we'll be able to add functionality and things that I couldn't do in Excel, like Excel has a limitation of, I think it was 9 or 18 things that I could put in a drop-down list. Those don't exist in our software, so we'll be able to add more things, and then we'll be adding on to that as we go, several different things that give you guys additional functionality. So that's super exciting. I'm very happy to be able to share that with you, and really appreciate you guys sharing your thoughts as we go through it and as you use it. So that is thing one. Is there any other news stuff, Dee, going on that we should talk about before we jump into the nitty-gritty stuff?
I think we're good. I sent everybody a reminder that you also have a free bonus of the LinkedIn training that we're doing on Monday of next week. So I sent out, I think you've gotten 2 or 3 emails from me on that. So mark your calendar because that is a 3-hour class. That is a bonus that we're giving you that we just really feel will be useful for you. So super excited to offer that to all of you as well.
Awesome. And yes, it is. I don't know if it's up yet, Brad, because it's on a dev server right now, but dealdone.io is where that software will sit. So we'll let you know. It's supposed to be live on the 18th of this month. So as soon as that happens, we'll definitely let you know. So
Roland,
don't go there now, or you can go there now, but it'll say there's nothing there because there's nothing there. So as soon as it gets moved off the dev server, it should be live on the 18th, but we will let you know the moment that it is.
You said Deal Done, right, Roland? Because you
Deal Done, DEAL. I put Dean Done. Nice. Yeah. That's when Dean Graciosi is finished with a seminar. You go to Dean Done, dealdone.io. There, I can type. Okay, awesome. So, and thank you for the belt shot, Emmanuel. That's awesome. I like that. Appreciate that. Okay, so let's jump into the stuff. We went through 25 of the strategies last time, and as I mentioned, I'm still working on getting this into a digestible form. Ultimately, what we'll do is you'll be able to ask questions. This is why the software is helpful, and you're living through the evolutions of it. But where we're headed is that you'll be able to input your information, and then it will spit back potential scenarios for you to buy, and it'll ask you questions and kind of walk you through the process. But that's in version 2 and 3 and on the roadmap down the way. But right now, we covered the first 25 of these strategies last time. So this time, we're going to go into as many as we can get through today. So the first group of them that I want to talk about is non-competing equity splits. So non-competing equity splits happen when some third party who has a business that would like to access the customers that the business you're acquiring has, but that doesn't compete with that business or with your plans or your business, right? For your plans for the future of that business or that. That's a non-competing partner that comes in, and then they come in with the cash, and you bring the deal to the table. And it works really great because there's no competition. So now you can stack these so that you have deals within deals within deals, which we'll talk about later in more advanced iterations of this. But the first thing to think about is this non-competing, and remember these, by the way, are all green so that you know that these are things that you do before you go in and do your letter of intent. So the first one is the non-competing equity split number 1. In this case, the third party is providing 100% of the funds, and you're bringing the deal to the table. and you're allowing them to come in at the valuation that you're coming in at. So let's say that you're acquiring the business from the seller for $1 million, and this person comes in and brings in, let's say it's a $200,000 down payment. This third party comes in, brings the $200K, and you guys, you basically for that $200K give them 20% of the company, because it's $1 million valuation. Okay, so they're putting in $200K, 200 divided by $1 million equals 20%. Very, very straightforward. Now, the next iteration of that is the same in that it's an equity split and the third party is coming in providing the funds, but now they're acquiring at fair market value. So the fair market value may be significantly more than you're paying for it, because remember, we're buying things from motivated sellers, ideally, right? I know some of you keep trying to buy from non-motivated sellers, but our goal is that you identify motivated sellers. So when you're buying from them, you're buying under market value. So it's fair for you, once you have your deal locked up, to let the other people come in at a higher valuation. So maybe you acquire it for $1 million, but the fair market value is $2 million. So in that case, you only need $200,000, and the third party comes in with $200,000 at a fair market valuation of $2 million. 200,000 divided by 2 million equals 10%. So now that's the difference between those two. And there's absolutely nothing wrong with doing that. You're the person that found the deal. You can do that in a consecutive closing or a simultaneous closing. There are lots of ways to structure that, but you are basically having the people come in at a higher valuation than you acquired. The third iteration of that is that they're providing other assets or resources that will help you either in the business to not have to put money in, or they will help you to pay the seller. So that's just, instead of providing cash, they're providing third party, they're providing assets or resources. And then the last one is that they're providing a combination of those. So you can structure these any way you want, but just knowing all the different combinations of how to do each one of these, I think, is really helpful. So those four in that category: third party provides 100% of the funds, they acquire at your purchase price. Second one, they provide 100% of the funds, they acquire at fair market value. Third one, they provide other assets or resources, can also be fair market value or the price that you acquired. And last but not least, they're providing a combination of funds and resources. The next one is that it's called a wrap. And this, the wrap comes originally from real estate, where there's a loan that is on the assets or the property. So in this case, the seller has a loan, and maybe there's a due on sale clause. Maybe there are other loans that the seller has personally taken out to help fund the business. In this case, you are wrapping those loans into the purchase price. So let's say that the purchase price is $1 million, and the seller owes $600,000 in loans, and maybe some of it's credit card debt, maybe some of it's a home equity loan. Both of those are very common. Maybe there's an SBA loan or something like that, and there's clauses in those things that say that the seller's the only person that can be liable, and maybe there's an asset securing the loan, like with the SBA loan, that an SBA, Small Business Administration for everybody, maybe that contains a clause that says that in the event of a change of control or ownership of the business, then the loan becomes immediately due and payable. Well, we don't want that. So what we do is we have transferred the business, and rather than assuming the loan, I have assume here, I should say, wrap. You wrap those loans into one loan. So it's kind of like a consolidation. So all those little loans that the seller has, you just wrap them up into a single loan that your SPV has to the seller, and you take those over. So then that reduces the purchase price by the amount of loans that you're putting in the wrap. And that means that in this case, we had $1 million purchase price with $600,000 in debt that's being wrapped. So then you'd only have to come up with an additional $400K. Okay, that's a little more advanced, but still relatively understandable. Now, the next couple of things here are integrators. So you can have, remember we said that, I'm 31, we said that you can have no, typically the seller of the business might stay on, but very frequently you'll have the number 2, 3, or 4 person who's in the business come and run it. But sometimes you'll have to go and find somebody that's outside the business. So if you're finding somebody that's outside the business, and I've done this several times, and really funny, accountants, like the accountants for either my accountant or the business, or the banker for me or the business has come in and said, I want to be part of that, because they see these deals that you're doing and they get excited about it and they want to be part of them. So they'll actually ask, can I come in? And if not, just be sure you're telling your bankers and the people that you're working with all the stuff you're doing, because this builds excitement and will increase your investor database. So they'll come in as an outside integrator. Integrator just meaning somebody that's going to operate the business, since we don't want to, and they'll invest either cash or assets. So that's an outside integrator investor. And then if you get the number 2, 3, 4 person, somebody that's inside the company that's never had equity, that's now going to come up and have the opportunity to have an ownership stake in the company, that's the other place that we can look for investors, right? Integrator investors. So same thing, just they're either coming from outside the company in 31, and 32, they're coming from inside. Number 33 is a short-term note payable. So this is really simple. So as opposed to the classic DDP, the deferred down payment, where you're just saying we're gonna provide in the escrow instructions that the down payment's going to be made 30, 60, 90 days after the close. This is where you actually are executing a note, a promissory note, and giving that paper, which is basically like a legal IOU, to the seller on closing. So they're getting a short-term note payable. And that's, like I said, usually it's under 6 months, and most frequently 30, 60, 90 days, just to buy you the time to get inside the company and then do the post-closing manipulation, the post-closing financing that you have to have title to the assets to do. Number 34 is similar. It's just, instead of a note, you're providing assets. You're actually giving collateral over to the seller. So maybe you've got a $10,000 watch, or a $1,000 watch, or a $10,000 car, or whatever, and you just say, hey, seller, look, I'm going to let you hold this asset during the next 30, 60, 90 days, just to be sure it's collateral for you to be sure that I'm going to pay you back. That's all 34 is. I highlighted too much. And then 35, you're asking the seller to subordinate their carryback financing. So this is a two-step to get to this. The first step is the seller agrees that the seller is going to finance part of the purchase. Then you're going to go and get a loan from a third party or an institution or whoever, and you need the seller to agree to subordinate their loan. You need to do this, need to get this agreement before you close, because if you need the seller to subordinate after you close to do some of the things you want to do, it's probably going to be too late, and the seller's going to either say no, or they're going to say, I'd think about it, but what's in it for me? And so you'll have to end up giving them something else. So it's better to know in advance if you're going to need the seller to subordinate. And remember, all subordinate means is there are first, second, and third positions of loans. So when you're, and real estate's a great example. In a real estate, when you buy a house, you put down, let's say, 20%. And there is a loan for the remaining 80% that's usually sold off to Fannie Mae or somebody like that. So now they have a first position. So if the house sells, they get their money first before anybody else. If you then go to a bank and get a HELOC, a home equity line of credit, or some other loan on the house, that's going to be second in place after the Fannie Mae or the bank that made the acquisition loan, right? So you wanna understand that the first position gets paid first, the second gets paid second, the third gets paid third, and so on. And where this matters is ultimately, let's say that you buy a business for $1 million and you get 80% financing from SBA, let's just say in this case. And then the sellers agreed to carry back 10%, and then you go and get another loan on, so $1 million, 800,000 is financed SBA. You get 100,000 more from the seller, and now you go out and get another $200,000 loan from a third party. Now the business is over leveraged. There's $1.1 million in debt on a business that is only worth $1 million. And let's say things go wrong and the business sells for $830,000. Well, the third place person that loaned the 200K, they get wiped out completely. The second place person, the seller who carried back 100K, because it was only 830,000 that the business was sold for, and there's a first for the financing company SBA for 800K, that means that the seller is going to lose 70,000 as well. Because from that 830,000 that comes in, the first 800 is going to go to pay off the SBA. That's going to leave 30,000 in cash. The second place person is the seller. The seller's owed 100K, but only 30K in cash there to pay them. So they're going to get 30 and they're going to lose 70. So that's why it's important to understand how that works, and then understand that there are times when you're going to need the seller to subordinate in advance. Okay, 33, that's a short-term note payable is used for your down payment. So that's just a little different from a promissory note. In this case, it's just the standard classic DDP. So it's typically contained in the escrow instructions as opposed to it being a separate document. 34, let's see, is that what happened there? Let's see. Okay, I went through that one, sorry. Seller subordinates, okay, great. Okay, sorry. And now 36, I need to raise this as I'm talking about. 36, the employee who is not an integrator level investor. So this is like the employee is not that number 2, 3, 4 person that we're going to bump up to be the operator of the company. This is just another employee or group of employees who are in the company that you want to give the opportunity to have equity, which a lot of times they're very excited about. And a lot of times they've got 401ks or other investment vehicles that will allow them to take money and invest. So don't forget that the employees of the company can be a great financing source as well. So in this case, those employee non-integrator level investors are investing cash or assets in the business, and then you use that towards the purchase price or the down payment. 37, this is the same thing as the employees, except not an employee, but a contractor. So the business might have independent contractors that work for it as well, and those people are frequently interested in investing. The best place to find investors, by the way, is friends, family, and acquaintances that you've got, and then people within the business or that are doing business with the business. That's like, because they already know the risk. They already know that it's a good company, that it's a good investment. And so, and frequently they'll have a vested interest in seeing that the company succeeds. And so they'll want to have an ownership interest. And it's good for you, for them to have that interest as well. The next one is third-party hypothecation. So this is where you get a third party to replace place collateral with the bank or some other lender in exchange to get the lender to make the loan. So effectively, you're borrowing the collateral from a third party who's willing to place their collateral with a bank. That's called third-party hypothecation. And then the bank or the lender, whoever that might be, will then give the loan to your SPV for the company. 39 is really funny, and we've used this a few times. This is where we are effectively using our credit to buy the thing that things that the seller would like to buy with the money. So this is why it's really important to always say, what will you do with the money? Because if you talk to the seller and the seller says, yeah, I'm going to put this much in just cash in a money market or something, great. How can I give them a higher return than the money market? That gives me an opportunity to do that. What else are you going to do with it? Well, I've always wanted to take that trip to Wuhan, China. Always wanted to go there. So I'm going to do that. So you basically then find out, I imagine tickets are pretty cheap right now. You basically place those tickets on your credit card to give them the tickets. So at closing, you will deliver to them the tickets to Wuhan. You will deliver them, maybe in one of the deals that we did, there were 2 Rolex watches. Both the guys wanted to have Rolex watches when the deal closed. And so you can go and put, and that's a significant amount of money. So if you've got room on your credit card, you can do this. If not, you can go to Ty Crandall or somebody like that we did a call with and say, get me a bunch of credit cards in the name of the business. And then he'll do that. Now you've got 150K in credit cards. You go buy 2 $70,000 watches. And now you give at closing the 2 watches to the seller. The deal closes, and now you've got the company, and you can pay them off on your credit card, whatever, on the company's credit card, whatever way you want to, right, within the terms of the credit. So that's kind of a cool way to get financing. So it's always important to ask, what do you want? What are you going to do with the money? An advisor loan. So this is if the company has an advisory board. Again, I mentioned that the people who are associated with the company, most likely easiest place to get investors. They're making, in this case, a loan. The advisor on an existing advisory board is going to make a loan to the company to be repaid from the business operations, and then you use those proceeds to help with the purchase price or down payment financing. You can set up a new advisory board. So remember, even if the company doesn't already have one, you can set up a new one. And then as part of that, say, and we'd love to give you the opportunity to participate in the success of the company, and we don't want you to have any risk. So how about you make a loan of X to help us do this acquisition? Then you're an advisor as we go forward. So that's another way to do that. And then as opposed to a loan, you can do that with an investment. So the existing advisory board, you say, would you like to make an investment in the company? And same thing with the board. An existing board member makes a loan to the company, or an existing board member makes an investment in the company, or you set up a third party, you set up a board and then have them make a loan or investment in the company. So this set here is very, very, very common. These let's get advisors on the advisors either that exist or board members that exist to either loan money or invest in the company to allow you to make the purchase, or set up an advisory board or a third-party board so that you can have people who do that. Number 46 is one of the more complicated things you can do, and I really need to, I think I have a case study on this in the videos, but I want to break this one out for you more. But basically, a staggered tranches PPM is that PPM stands for private placement memorandum. So we're going to do a private placement memorandum, and let's say that you want to raise $5 million. So we're doing a 505, Regulation D 505 private placement offering for $5 million. And we're going to raise that over time, and we're going to have a dynamic valuation so that basically the valuation of the company is going to adjust based on a formula for how the company is performing. So here's the gist of this, right? Again, Jillian Sidoti, we did a session with, you guys can watch, and she and I can hop on a call if this is something you ultimately decide you want to do. But what happens is that, let's say that you acquire the company at 200,000. So now you've got the company for 200,000, and you take that, you own it now, and now you need to raise some money to pay for part of that company. Let's say that you needed 40,000 down, 20% down. So maybe you raise 40K to start with at a valuation of 200,000. Okay, so now you've given away 20% of your equity, but then you do your magic that you know how to do, and you increase the valuation of the company to 500,000. And now the payment comes due to the seller on seller financing. Well, now if you were to sell another, let's say you need another 50K now, right? So we've paid 40K down, and now we need another 50. But now the company is worth 500,000. So if you sell 10% of the company at 500,000 to raise that 50, you're getting the benefit. You've made money between the 200,000 valuation and the 500,000 valuation. So that 50K that comes in, you only give 10% up for, and now you've got 70% of the company. You gave away 20 at the start for the first 40,000. You gave away only 10 on the second phase of financing for 50K, right? So now you've had 90K. So then let's say another year goes by and you need another, let's just say 100 to wipe it on out. But now you do that at a valuation of $1 million. Well, now when you sell that next 10% at $1 million valuation, you get 100K. So now you've gotten 190,000 through 3 different investments. But the first one you raised 40K because the valuation for 40K for 20% because the valuation was 200K. The second time you raised 50K for only 10% because the valuation had gone to 500K. And the third time, you raised 100K for 10% because the valuation was $1 million. So you've given away 20 plus 10 plus 10, or 40% of the company to raise 100% of the money that you needed to pay off the company. You've come out of pocket zero and you own 60%. So I hope that makes sense. That to me is a really brilliant model. It's a little more complicated, but you're taking advantage throughout to only get, it's really JIT financing, right? Just-in-time funding. So you're really just getting the money as you need it. And so you think about how you're going to have to, when you structure the deal, whatever you have to do to get the deal done with the seller, then you know how much funding you need when. And so then you're just trying your best to increase the valuation along the way so that you can get funding at increasingly greater valuations, which is only how every company from Uber to Facebook does it, right? Anyway, I think that one's a really cool strategy. You can do reverse wholesaling. So reverse wholesaling is where you go out and you find a company to buy. And I know a lot of you have found companies and then, but you're going through brokers and they require cash. But you can still reach out to your network and see if somebody's interested in acquiring the company and simply get an option to acquire the company at whatever deal you can for a period of time, like 90 days or 120 days, an option to acquire the company for a fixed price, and then you sell it to somebody else who's going to buy it, and you basically are just making the spread. So let's say that you're able to get a contract to buy a company for $500,000, and you find a buyer that's willing to pay $750,000 for it. So you're picking up the spread of the $250K when you do that. 48, deferred payment and liquidate. So here you're negotiating a deferred payment with the seller, like a DDP of sorts, right? And then you're just going in as a corporate raider effectively. This is not a particularly good for the world kind of thing to do, but it is what happened in the 80s a lot, and it's starting to happen again now, is that you're going to negotiate a deferred payment, and then you're going to go in and liquidate all the assets to pay off the seller loan before it comes due. And that could be a short period of time. So like we're actually redoing the coping on our pool right now, which is stone, right? And there's a quarry. Let's say that quarry wants to sell, and let's say it wants to sell because it's got some debts it's got to pay, and it's got some other things. You're able to negotiate a really great price on it for $1 million, but you know that you can go out because you happen to know contractors like I do, right? That use lots of stone, and you can go out and say, tell you what, I can get you a great deal if you're willing to buy this now at liquidation prices, and you end up selling the stuff for $1.5 million, you pick up $500,000. So you're just basically going in, liquidating everything, firing everybody, selling every asset, all the furniture, fixtures, equipment, phone systems, the inventory, everything. It's just a liquidation, but you're going to run it because you're better at it than a panic seller that doesn't know what to do. Okay, 49. This is where you're going to do a gross cash flow assignment for the down payment. So you're going to assign some portion of the existing target business's gross cash receipts to the seller to pay part or all of the seller financing, okay? And this differs from the next one, which is net sales. So gross sales is all sales, and it doesn't take into consideration returns, discounts, allowances, chargebacks, anything like that. So if you're going to do a gross sales deal, I don't like gross sales deals, right? I like net sales deals way better, because net sales means that you're going to pay the seller 100% or whatever agreed on percent of the cash proceeds that the business is going to have for some period of time, but they don't get, it's going to be adjusted for chargebacks and refunds and things like that. So the bottom line, though, is you're going to agree on a portion that will continue to allow the business to deliver and to operate. But remember that frequently, particularly if the business is selling inventory or even non-COGS, like non-cost of goods sold assets like information, that there's a backlog. Either the information already exists, so it doesn't cost anything more to create, or the software already exists if it's a SaaS company, so it doesn't cost anything more to deliver except maybe API call or bandwidth prices. Or you've got a backlog of inventory like many physical product businesses do, so you don't have to buy more inventory while you're selling the overstock right now. So let's say that that you've got 500K in inventory, and you assign the gross, you assign 75% of gross receipts, gross cash receipts for the next 90 days. You could sell you could sell, what is that, 166,000 a month of that inventory and give all of that proceeds to the seller before you ran out of inventory. And then move to a JIT, a just-in-time system, or work a deal for a consignment or a loan from the inventory supplier. So you're using the assets of the company to fund its operations, and then assigning the receipts, whether gross or net, some portion of those, preferably not all, to the seller so that the seller gets paid their down payment very, very quickly. You can do the same thing with a margin deal instead. So instead of saying, I'm going to assign you gross sales or net sales, you can also say, based on the financial statements, the business operates at a gross margin of 70%. So 70% of all sales that come in, I will assign you that. So that you're basically trading then not on gross sales, but on the gross margin that you make. So let's say if it's 70% margin and you sold $100,000 worth of stuff, then there would be $70,000 of gross profit in the business. So if you assigned 50% of that, they'd get 35K. So that allows you in a business that doesn't have backstock of inventory or non-COGS things to sell, it allows you to still do a deal like this. So that's a gross margin cash flow assignment down payment. Lots of words there, but you get the concept. 52 is very, very simple. You're just going to do a credit card down payment. So you're going to purchase a product from the seller on their merchant account, which you are taking over, and then that is providing the financing for you to have cash, because the seller is going to receive the cash while the seller owns the business. Then you're going to take over the business, and then that obligation is going to pass to your SPV. So it's just a way to use the seller's existing merchant account to get cash to the seller. You can also take 53, you can take ownership of the business at closing while taking on the seller's debt on a subject to basis. So this isn't a formal assumption with a document where you say, I hereby assume the seller's debt. You're saying, I'm taking it subject to, meaning that I'm taking it over, but I realize that this debt has to be paid off. I'm just not going to assume it. It's kind of a legal distinction between an assumption where the debt becomes your SPV's debt, or a subject to where it remains the seller's debt, but you still know you have to pay it off, because if you don't, somebody's going to come and take stuff from the business. You can also do a debt wrap. So we talked about wraps earlier of personal debts. You can also do company debt wraps. So whatever debt the company has, rather than assuming it, you're just going to wrap it all under one obligation to the seller. You can assume part of the seller's debt. So that's the difference where you're actually going to the person who's the creditor and saying, listen, I want to assume this. I'm going to be responsible for the target acquisition's debt, and I am going to, and then you need to let the seller debtor off the hook, so they're no longer liable. That's an assumption is going to transfer the debt from someone else to you, and then they're no longer liable for it, usually, although there are situations where they can be. So you could do that with 55 with part of the acquisition's debt, or 56 with all of the target acquisition's debt. And then you can also, without a formal agreement, you can, with a formal agreement, you can assume. So we talked about wrapping debt earlier. Now, assumption is that you're going to the seller's personal creditors and saying, hey, I'm going to take this over now. It's going to be my debt. Please let the seller off. And then you've got seller inventory consignment. So this is where the seller is going to consign the inventory to you. So you're going to basically get the fair market value of the inventory and look at the cost and the fair market value. And you can use either one, right? So you're going to then deduct either the inventory cost or its fair market value from the purchase price. And then the seller's effectively still owning that. That's why it's coming out of the purchase price. And then as the inventory sells, you're going to pay that pro rata amount to the seller. So let's say you have 100,000 pieces of inventory that are worth, that cost and are worth $2 a piece. So that means that each time a piece of that inventory sells. That's 100,000 at $2 a piece, right? So that 100,000 pieces at $2 a piece is $200,000. So now let's say that month one we sell 50,000 pieces of that. Then we would pay the seller $100,000 because we sold 50,000 pieces. If we sold 18,000 pieces, we would pay the seller 36,000. So we just pay them $2 a unit on sale until all of their inventory that they owned was sold. Okay, so that's kind of a cool thing. And the reason that you want to look at fair market value or cost is that if the fair market value is less than the cost, then you want to be sure that you're not giving the seller credit in the transaction for more than you should. So you want to see if there's obsolesced inventory, you want to be sure that that's not figuring in to the cost of the business. The other thing you can do is you can assume the taxes. So you can assume the tax liabilities of the target acquisition as well. And so that would be another debt that the seller would otherwise have to pay off when it closes. Just be sure that they're not overdue and that you can't afford to pay them from the proceeds of the company operations. You can also do a double escrow. So this is when you're closing the sale on the acquisition and then you're immediately reselling it at a profit to another buyer. So this is kind of like the reverse wholesale, only this is just truly a double close. You're not finding, you're not doing an option. So you're basically just saying, I'm agreeing to close the business on this date. There isn't an option involved. And then you're going out and finding somebody else to purchase it. So it's good to know the buyer before you close the deal on the business, by the way. This is using my good friend Frank Kern's 4-day cash machine. So this is a deferred close with the 4-day cash machine where you go and you take over, your agreement says you're going to take over running the business for a very brief time before the closing, but you're deferring the closing for a short period of time. And then you run a 4-day cash machine to provide the purchase price or down payment for the closing. And if you don't know what 4-day cash machine is, Google it, and there's a PDF that walks you through what that is. So that's just a way to generate cash to pay the seller. You can also defer the close and the sale. So you're taking over running the business, but deferring the actual closing for some period of time. Again, it's usually 30, 60, 90 days. And then running a sale of the business's assets. So, a sale at the business. So that's usually we're just running a straight sale. The 4-day cash machine is a very specific methodology. This is just a general sale. Also, 63 is the working capital adjustment. And so to understand this better, listen to the call that Grant and I did on the breakdown of the stock and asset purchase agreements. We did 2 parts of that call. So if you listen to that, we talk about it, but this is the negotiation. The working capital adjustment is the negotiation of how much gas has to be left in the car when you sell the car to make it go. So when you sell a business for a multiple, the multiple includes the idea that there will be enough working capital in the business to operate the business going forward. So whether the business is a cash or accrual accounting model, how much of the sales that the business has made can be recognized or have been recognized, and then how much cash that's come in from sales will be staying in the company is important. So like when we sold Traffic and Conversion Summit, it's a great example because we sold tickets in advance, like 9 months, actually a year in advance, because we sell for next year at the current event. So we had a lot of money in the bank that was straight cash. And when we sold the business, we didn't get to go in there and take all of that money out. We had to argue about how much of that should stay in the company because basically the event hadn't been, the thing that the people paid for had not yet occurred. And the thing that occurred, which only occurs once a year, has huge costs associated with it. So the buyer wanted to have all of that cash stay in. And of course, we wanted none of the cash to stay in. And so the working capital adjustment allowed us to negotiate back and forth so that they were able to use part of the money that we already had in the business to pay for the business, okay? And you can do the same thing. So it's a negotiation, but remember that don't let the seller take the cash that's in the cash account out, okay? They're getting, and by the way, for those of you that confuses a little bit, the multiple that's involved in the business assumes that the business will be able to continue to operate. So that's why it can't just come with no gas in it. Opportunity zone. So outside the scope of a long discussion here, but there are opportunity zones in the United States, and there are other favored economic incentives to invest and purchase companies within certain territories. So you might want to look into the options that are around opportunity zones to provide very, very favored financing for the business. You can also use a second trust deed note payable as a down payment. So you can tell that I didn't get to describe that very well. But so this is a multiple step process also strategy. But if you are in the real estate business, you can purchase second trust deeds for deep discounts. And if the seller, so we talked earlier about how there's a first and a second and a third on properties, right? On real estate or businesses. So those seconds sell usually at a pretty steep discount. So maybe you have, if you're a real estate investor or if you have other businesses, maybe there is the possibility for you to acquire a second trust deed at a deep discount. So let's say maybe it's $100,000 trust deed, that's a 3-year trust deed, and you're able to buy it for $70K. Well, what you can then do is you can use that asset as a down payment with the seller, and it's possible, depending on how you structured that other transaction, that you didn't come out of pocket at all to acquire that second trust deed. Maybe you actually took the trust deed because you were selling a piece of real estate, and let's say that you sold a property at $100K, and the seller was able to get 80% financing, so they got $80K in financing, and then you took a second trust deed for the remaining 20. Well, then that 20 is effectively free to you, right? You didn't pay anything for that 20, so you can take that 20 and turn it into cash by offering that to the seller as a down payment on a business that you're buying. And typically when you ask the seller, what are you going to do with the money? And the seller says, I don't know, I guess I'll put it in a CD or a money market account or something like that. If they're just going to basically stay in cash or even invest in the stock market or something like that, then you just have the discussion and say, well, that investment typically pays 8%, or that if it's the stock market, that investment typically pays 3%, or 1% if it's a bank money market type of instrument, and I'll give you effectively 17%. So I'll give you this trust deed that has a 17% interest rate. So there's a lot of opportunities to arbitrage that. That's probably worthy of an entire call, but as a strategy, just know that you can use second trust deeds as down payments, and it's a really, really fantastic way to go. Alternative lenders, if you talk to Ty Crandall, if you listen to the call that we did with Ty Crandall from Credit Suite, that is just going out to all of the other types of lenders that are out there, and Ty specializes in that, so you can talk to him about how might you use alternative lenders to finance your particular deal. And then the next few are all small business association type loans. So these are the different loans that in the United States the SBA, or Small Business Administration, makes available, and they're really great. The challenge with them is that they generally require personal guarantees. Now, they might not necessarily require your personal guarantee, because if part of the deal, and remember we're in the green things here, all these are highlighted green, means this is stuff we do before the deal. It's possible then to have the seller get the loan, say, if you really want to sell the business, let's get an SBA loan, and then I'll wrap the loan into the purchase, and we'll agree in advance as a condition of sale, you're going to get an SBA 504, 7A Express, etc. loan, and you're going to be personally liable for it, but my SPV is going to wrap that as part of the deal so that we pay the note. Now, why would the seller personally guarantee something that you were going to take over? Because they're motivated, because they want the cash. So, be careful not to impute your level of comfort with risk onto the seller, because the seller's got all kinds of reasons. Remember, we talked about the 9 big reasons that sellers are motivated. When you're dealing with a motivated seller, there's much more flexibility to do something like this. Now, if you're comfortable getting up, doing a personal guarantee, then you can personally guarantee these loans too. And we talked with Ty Crandall on the Ty Crandall call, which is in your portal, about the different types of loans. 504 is usually to acquire an asset. 7A is usually to acquire a business. 7A is 7A Express is to acquire a business when you don't need or inventory or an asset when you don't need a lot of money. I think it's $350,000. The export is for export loans. The micro is for very small loans. The disaster and idle loans are if there's something going on in the area or something bad is happening. The PPP is actually really cool because like for one of our companies, we got a little over 1.1 million, and we are using we're doing this as a discipline within the company to say that we're paying all the things with that PPP, with that 1.1 million, we're paying all the things that we know will get that loan forgiven. So at the end of the day, we'll effectively have an extra $1 million in the company. So you can go and get a PPP loan in the company, and then if the company's operations will support the things that you're going to pay with the PPP, like for us, we would still survive and not fire anybody even if there wasn't a PPP. But because we got the PPP, we're using it to pay things that we have money to pay. So the money that we have to pay that, we're putting in a savings account every month as we pay. The best way to say it would be an example, right? So let's say our payroll every month is $500,000. So we'll take $500,000 in money that came in, and we would normally have used that to pay the $500,000 in payroll. But instead, we know we have to use the PPP money to get that loan forgiven. So we're paying the expenses we need to pay with the $500K from the PPP. Then we're taking the $500 that we would have used otherwise that now we don't need because the PPP paid it, and we're putting that in savings. Well, what's awesome about that is that at the end of that 8-week period, we have 1.1 million in savings, and we've paid off the things with the PPP loan that allow it to be forgiven. So now we've effectively got 1.1 million in extra cash sitting around. So you can do that with your acquisitions during this time that this is in place. And apparently they're negotiating to have more of this. I don't know if it's going to happen or not, but I know the last time I heard there was still 67 billion available in PPP money that hadn't yet been deployed. So you can acquire a company, get its PPP loan. If it's able to fund from within, then just give the money that would have otherwise had to pay what you're now paying with PPP, give that money to the seller, and you're financing the acquisition of the company through a PPP loan. That's really, really cool. There's also a cap line, which is just a line of credit. So those are all SBA type loans, but they're definitely worth looking at because either you, if you're willing to personally guarantee, or the seller, if the seller is truly motivated and is willing to personally guarantee, can get those types of loans for the company. 76 is the short-term note payable for down payment. You can also use barter. 77 and 78 are, barter is the oldest form of negotiation where you have something, whether it be a service or an asset or a resource, that you're willing to trade. So barter just means trade, right? So you can trade things to the seller in exchange for the down payment. So maybe you've got a watch or or an iPhone, or I'm looking around the room, or something like that that the seller is willing to trade. Just trade them for the down payment, right? That's a great way to do it. You can also do third-party barter. So if you don't have the thing that they want, then you can trade somebody else for something that they want. So let's say that Patch wants a watch. So, and I'm buying a business from Patch, but I don't have a watch that Patch wants. And Patch wants, what does Patch want? Patch wants an Audemars Piguet tourbillon ceramic black watch, which I don't have. But I've got another watch that is of equal value, and so I go and I find somebody that's got the watch that he wants that will trade for my watch, and then basically I've gotten a third party to effectively provide the thing that he wants, because what he wants is very specific. And so I just have to go out and find that, trade that person that has that, something that I've got that they want, and then I make the trade with Patch. So that's a kind of a fun, like if you're really a deal person, that's a fun challenge to find out what are some of the things that the other person wants and how can you trade around to get them the thing that they want. By the way, there are barter companies. I think there's the American Barter Association. So there are groups that are barter groups, like there's a San Diego barter group that that have lots of people in them that all have different assets and are willing to trade. And so they effectively trade in their own currency of a barter currency. So it's not as hard as you might think to find that thing that he wants, because what I'd do is, like, let's say he wanted that specific watch and that I didn't have the watch connections that I've got, then I would go and look in the barter groups that I'm a member of and find jewelers. And then I would say, do you guys have one of these watches? I'm willing to trade this for that. And they might not. And then I'd go out to the wider group. Does anybody in the barter group have this thing? So there are actual networks that exist. You don't have to just happen to know somebody that has that one thing they want. You can do a refillable seller holdback that's applied to the down payment. So the way that this works is that in a transaction, if you remember the calls that we did with Grant Teeple on the acquisition agreements, the two-part calls on the stock purchase agreement and the asset purchase agreement, there's a holdback of usually about 10% of the purchase price to allow for things that come up that weren't disclosed, that it's not through anybody's fault, it's just stuff happens. And so a portion of the purchase price is held back. As a matter of fact, in the TNC deal, we're getting a release of a holdback amount now, right? We're actually getting wires, I think, this week for part of the holdback because it was released over a few years. And so what you can do to help finance your deal is tell the seller, okay, I'm buying this for $1 million. Standard holdback is $100K. But what I'd like to do is, rather than have to put that $100K in for the buy right now, I'd like to have an option of paying that in 6 months. And so I'll give you a note against the holdback, and then I'll basically refill that holdback at the end of 6 months. So you're not going to get the money anyway, Miss Seller, because it's going to go into a holdback. And to help make this deal happen, I just want to pay the holdback amount, not now, but 6 months from now, 9 months from now, whatever. Typically, that's a 3-year holdback, by the way. So unless you negotiate, like if you're a good negotiator on the sell side, you're going to say, well, we can do that holdback, but how about if we release a third of it each year for 3 years, right? Which is what we did. But a lot of times, they don't ask for that or just say no. And so anything that helps that person get that money faster will be something they'll be incentivized to agree to. So that's a really cool way to find additional money too. And you can also do that with a countering note payable. You can also apply it directly to the down payment. So there's lots of different things that you can do with the holdback. And then we get into owner carry. So there's a lot of owner carry things. Owner carry just means the seller is going to finance the part or all of the purchase price. And it's typically called a carry back because they say that the seller will carry or hold paper, a note, or a debt of some sort. So they'll carry back paper from the deal. So they literally would go to the closing table originally, and they would be an exchange of stuff. And then instead of carrying cash away from the deal, the seller would carry back a note, right? So that's where that comes from. But so just so you understand the terminology. So we've got a lot of ways we can do that. The seller can carry an unsecured note, meaning that there is no collateral that's pledged. The seller doesn't have a lien on any of the assets or the stock or equity of the company or anything else. And there's no interest on the loan, and there are no payments on the loan until sometime in the future. When a bulk payment is to be made sometime in the future, as opposed to amortized over every month or every year or something like that, it's referred to as a balloon payment. So in this case, we have an owner carry with no note payable, meaning it's unsecured, with no interest, and a balloon at the end. This is what you want to go for. This is your offer when you first make your offer in your LOI when you're talking to your seller. This is what you want. An owner carry, no note payable, no interest, and I pay the whole thing at some point in the future, 2 years, 3 years, 4 years from now, okay? Then you just go back from that to less and less favorable things. So your fallback positions here, which you have several of, is it can be an unsecured note payable as opposed to not having any note in the first deal. In 83 here, we've got a note payable that's not secured, but it is a note, and there's no interest in a balloon. Then we'll have our next fallback position is, we'll give you collateral. We'll give you collateral so you can have a lien against the assets of the business or the stock of the business, whatever, depending on how you buy it. And there's still no interest and no balloon. Or you have the unsecured note payable and it's interest only, so you don't have any principal amortization. You're just paying interest monthly or quarterly typically, and a balloon at the end. And then 86, we get an unsecured note payable with no interest, but we are straight line amortizing that. So straight amortization would be, let's say it's a million. It's easy. Let's say it's a $240,000 financed amount. Then we would finance that over 2 years at $10,000 a month. So that would be no interest on that money, just $10,000 a month, unsecured note payable. Then the next fallback would be a secured note payable with interest, straight amortization. So here we're having no balloon. That's the downside. The balloon is really cool because the principal of the loan doesn't have to be paid every single month or quarter when it is a balloon payment. So that means that you have more cash that you can use to grow the business, and then ultimately you pay the seller at the end of the day. Okay, so that's all the different. So that gives you what, 1, 2, 3, 4, 5, 6 different fallback positions for owner carry. So a lot of these are really cool to understand the different options, because then you know the fallback position. This is like, here's the money I've got, money in my left pocket, right pocket, back pocket, right? Okay, 88 is a third-party personal guarantee loan. So this is where you're going to have a loan with the seller, but the seller wants a personal guarantee and you're not willing to give it, or you don't have anything that the seller really wants or feels comfortable enough as a guarantee. And so you go to a third party and say, how about if you personally guarantee the loan and I'll give you either equity or interest or some payment up front or some incentive to get that third party. And we actually do these deals sometimes as a third party personal guarantor when it's just a fantastic deal and we're super oversecured and we get a lot of money. A lot of people will ask for short-term personal guarantee or short-term financing along those lines. Cash release to seller at closing. So the cash release to seller at closing is simply a way of carving out cash. That just says at the closing, we're going to pay you from the cash that's on hand X dollars or X percent. You can do an accounts receivable offset. So an accounts receivable offset is going to be where you let the seller keep their accounts receivable and you are offsetting that amount against the loan. So effectively a carve out of the accounts receivable. Then you've got a third-party co-signer for the loan. So that's a loan that's going to come on. It's not a personal guarantee. Personal guarantee is easier to get a third party to do because the only time that person, they're not actually on the loan, they're still liable for it, but they're not on the loan, so it doesn't affect their credit in any way. So a personal guarantee only means if another person defaults, if your SPV defaults, then that personal guarantor will be called upon to pay the debt. Whereas the third-party co-signer is actually liable with you equally, jointly and severally, we say in the legal world, for the debt. So if for some reason a payment doesn't get made, it's the same net effect. If the payment doesn't get made or if the loan doesn't get made, that third party will still be liable for it. It's just that it's going to show up on their credit if they are co-signer. It's not if they're a personal guarantor, typically. The other thing might be that you just go to a third party and you say, hey, how about you get the loan? You get the loan because I need you to have the loan. And I think, I don't want to say the name, but one of one of the people in the accelerator was doing a deal like this where they wanted a third party to get the loan. The third party was willing to get the loan in exchange for a piece of the equity of the deal. You can have the seller co-sign for the loan. Why would the seller co-sign for the loan? The same reason that they would be willing to do a personal guarantee on an SBA loan, because they want to get paid. So they're effectively then participating in the liability, but ultimately they're not going to have to pay it. So if you need extra credit that the seller has, then you can have the seller sign on a loan to help you get the money. They then take the money goes in the business and they get it, and then the business pays back the loan. The seller can pledge assets for a loan, right? Same thing. You can do credit card advances. So we do this just for kicks when we need a little bit of money to do a deal, like if we're buying a Facebook group or something like that. We'll just basically do a credit card advance on it. You can do it for $100,000, $200,000 frequently. So that you can do it for larger amounts, but we usually do other things. You can do credit card round robin. So credit card round robin is when you go to somebody like Ty Crandall at Credit Suite and you say, okay, if I was going to apply for a bunch of credit cards, by the time I filled out my second or third application, I would start getting declined because the companies would be hard querying my credit. And so each time a hard query for credit comes on, that's going to ding you, and it's going to cause the other creditors to look at that and say, this person's going out and getting a bunch of credit cards. I don't want to give them another one. But the way that Ty's company does it is they've got software that will submit out to everybody at the same time so that you're able to get multiple credit cards approved before you get hard queried, right? So it's basically like one hard query, and then you get all of the ones that you can qualify for so you don't get turned down after the second or third application. And it gives you a whole lot more flexibility to get more credit. Now, credit card round robin would be when you then go to each of those credit cards and get $5,000, $10,000, $5,000, $8,000, whatever the cash advance will be, and then you use that amount for your down payment. You can do the same thing with bank loans. And again, that's something Ty can help you with, that you don't want to just go sequentially around to lots of different lenders as opposed to having someone who knows how to do this all at the same time, because it doesn't work unless you have somebody that has the ability to do it all at the same time. Another thing you can do is you can sell back rights to the seller in the negotiation. So maybe the seller would be willing to, the seller wants to still operate in some parts, or you only want to operate the business in one geographic territory or in one vertical, right? So you can do a non-compete abatement, meaning that while the seller would normally not be allowed to compete in the entire United States, you only really intend to market in California, Texas, Florida, and New York, and Chicago's not a state, and Illinois. I got it, Illinois. So in that case, you might say, I'm going to geo-abate the rest of the United States, or I'm going to geo-abate the eastern United States, or maybe it's a worldwide deal and you say, I'm going to geo-abate Latin America or South America because you can handle the Spanish-speaking market. I have no intention of going down there. And so for that, you're able to get a reduction in the purchase price. And you can do the same thing with verticals. So you can say, the company's operating right now in the farming industry, and that's where I'm going to grow this company. And I know that you also are operating in the trying to think of something else you could use it for, in the harvesting machine industry. And so I'm going to, that vertical, I'm going to let you keep. Or maybe it's cosmetics and you say, I'm interested in skincare, not makeup. So I will abate makeup to you and I will only operate in skincare. And so I want a vertical abatement on the non-compete of X $1,000 or X% of the purchase price, because you can then go do that. So you're effectively just slicing up the rights of the company, which is something a lot of people don't think about, but it's a really great way to be creative in deals. I mentioned before, you can do 100% promos. So this is where you are going out and you're doing a test promotion of your product to the seller's list, and then you're applying 100% of the proceeds to the down payment or the purchase price. So it's, instead of doing an affiliate deal where you're splitting 50-50, you're just saying, hey, I want to be sure that this company can actually support that these people will buy the things that I think I'm going to use to grow the company. So I'd like to do a promo, and I tell you what, I won't keep any of the money from it. Just give me a credit towards the purchase price. It's kind of a fun way to do a deal. You can do an IRA loan. IRA is an individual retirement account in the United States. There are similar things in other countries. So there are loan amounts that you can take from a personal IRA. Talk to your estate planning attorney or advisor to get the exact amounts, but typically there's a certain fixed amount of money that you can borrow from a retirement account to make an investment. So that's a way to find money. IRA Rob is a rollover as business startup. So that is a procedure. You can talk to self-directed IRA companies like Horizon Trust or Equity Trust, and we can refer you to those companies if it's something that you'd like to explore. But it's a specific kind of IRA rollover that will allow you to invest in your business. And it says startup, but it doesn't have to be a startup. You can give the seller a couple of different options for giving the seller royalties. So if there is intellectual property in the business that you'll be using, like let's say it's a software business, then for every subscriber to the software, or maybe it's a product, like a patent on a product, you've got Poo-Pourri or something like that. And then what you're going to do is you're going to pay the seller a royalty in exchange for a reduction in the purchase price. And you see this on Dragon's Den and Shark Tank a lot, where they use royalties. So the seller will get paid by you for either in perpetuity or for a fixed period of time or until a certain amount gets received, and that reduces the purchase price, or that applies to the purchase price. And that can be done with a royalty or a license or a unit royalty. So it can be based on, if it's just a straight royalty or license, it's typically based on a percentage of sales. If it's a unit royalty, just like we did when we talked about inventory consignment, then it's based on each unit that's sold, a certain amount goes. And Marcus Lemonis did this as well on the key lime pie company. It was like Miami key lime pie or Florida Keys key lime pie or something like that. So if you want to watch that episode, you can see him negotiating that. And unfortunately, he gave that to the seller, which was, to me, a mistake ultimately, because he was going to put a lot of money and make it successful. You can do a backup loan from a third party. So this is just where you've got multiple people lined up. And this is something that we should have done when we were trying to buy that food company. It was $109 million food company. And we had our family office in the deal backed out at the last minute. And we had to go and scramble and get a backup. But because we didn't have the backup in place before, we lost the deal because the people that we brought in as the backup who agreed to do the deal couldn't do their due diligence within the due diligence timeline that we had to close the deal. So the seller ultimately said, if you can't close on the date that you originally agreed, then if you can't guarantee me you can close by then, he said, he was a jerk, then I won't do it. And these guys, this was a multi-billion-dollar fund, so there was absolutely no reason for that to happen, but it cost us the deal, and I would love to have that deal. One of the guys, it was a very, very well-known brand. One of the guys in the deal said, we closed this deal, I'm tattooing it on my arm. That's how big a deal it was. But had we instead gone to them and said, we'd like to copy you on the due diligence, and we get permission from the seller to do that, so that if anything happens with our family office, then you guys can step in to their shoes and fund it, which they would have done, then we wouldn't have lost that deal. So that's 106 was learned the hard way for me. It cost me several $1 million. You can do split offs of the real estate. That's just that you're going to say, I'm going to split the real estate out of the deal, and either we'll do a separate contract to purchase that, or we're just not interested in it. You can do barter arbitrage. So this is where you're acquiring So the seller says, in this case, Patch wanted his Audemars Piguet tourbillon ceramic flat black watch. I don't know why he's so hung up on that watch, but he's not. It's just me. And so if he says, that's what I want, now I'm a watch guy. So I used to buy and sell watches all the time, right, for a living. So I could go to my connections, and that's I think it's about a $350,000 watch. So I'd go to my connections and purchase it or trade a watch that I've got that I know they want. I could trade my watch to them, pick that up effectively for $100K, and then I could use that to trade to Patch, who knows it's a $350,000, and maybe I even give him a discount and say, hey, I'll trade it to you and just give me a $300K credit. And he'd be like, yeah, because I was going to go out and buy one for $350. I'm happy to give you a $300K credit, but I arbitraged it because I was able to acquire it significantly less. That you can do a lot, by the way. So again, so important to ask the seller, what will you do with the money? What will you do with the money? You got to know that. That's why you got to talk to the seller. Reverse merger doesn't sound that intimidating in 109 when you just say reverse merger, but it is fairly complicated. It is a transaction. It's a way of going public without having to file a registration statement, because you are acquiring a public shell, a company that's already publicly traded but has nothing in it. And I used to build those, by the way, from scratch and sell them. So I've done a lot of reverse mergers. And as a matter of fact, I did so many of them that I was told I couldn't do them anymore. So the idea is that you have a non-public company that you're acquiring, and you acquire a shell, a public company in advance. Then you merge the company that you're acquiring into the public shell, and the seller receives free trading stock or restricted stock or stock that has a restriction for some period of time, but they're effectively receiving a stock in a public company in exchange for the assets or the business that they're contributing into the public company. Now, you need to go and either form or acquire that public shell in advance. And I will tell you from experience, there's another gentleman that teaches some similar things to what I teach, who's a great guy, great program as well. His name is Jeremy Harbour, and he has a thing called the Harbor Club. And he came up with this thing he calls the agglomeration, and there's a book on it, I believe, as well. And he did this, and he was able to build the value up significantly, but then he got hit by these horrible people that Jillian Sidoti and I talk about in the interview that I did with her in the Zoom call that we did for this program with her, called short sellers. So these people will go out and basically they have rings of people with groups and a whole organization and apparatus to systematically drive the price of a thinly traded, meaning there's not a lot of people who are out there that have the shells, and there's not have the shares, and there's not a lot of daily turnover in shares. So in those companies, the way that public companies work, I'm trying not to get too complex here or too deep, but is when there's a stock price that you see that's quoted is the highest price at which a market maker, which is someone who's dealing in the shares of the company, like an investment banker, is the highest price that they will pay for a certain number of shares. And there's a system that allows market makers to say, I'm willing to support this stock by being willing to buy this many shares. But the top price, the reason you see stock prices change so quickly, if you watch a ticker, is that the top price that somebody's willing to pay for is only for a certain number of shares. And in one of these shell companies, that price that is quoted, maybe it's $15, might be only 1,000 shares that somebody's willing to pay $15 for. And then, as if you put in a trade, let's say that you put in a trade for 10,000 shares, that you do a deal with a seller, and you give the seller 10,000 shares, and it's valued at $15 a share because that's the quoted price. Well, what happens is if they were to immediately go and sell, this is why you typically do a tie-up agreement with them. If they were to immediately go and sell 10,000, then they would sell through the first bid of the market maker that's supporting the stock because they were willing to pay $15 for 1,000 shares. Then the next bid might be $12 for 2,000 shares. Well, now your seller's gonna get the $15 for the first 1,000. Is going to get $12 for the next 2,000. They've still got 7,000 shares, and so that 10,000 shares could very well run the stock down to $6 in a thinly traded company. So when you get these short sellers that come in and start trading on margin and selling other people's stock in advance and driving the price down, their goal is to take the price to zero so they never have to go and replace the shares. And that can be a very big downsell. Now, there are companies, Qualcomm, which is a huge company, started off as a reverse merger. There's lots of success stories of reverse mergers. But if you don't have a real demand for a lot of shares of the stock and good, strong, actual experienced market makers that are willing to support the stock at a high level and really believe in the company, this is a terrible way to go. So know that it's an option, and it is a good option in very specific circumstances, but it carries some pretty big risk as well. You can do a third-party franchise sale. So now I put franchise in quotes because maybe you don't go through the entire franchise process. To be a franchise, you typically have to pay a fee in advance to use a third-party brand and a royalty. Those are the three parts typically of a franchise test. So if you can create for someone else who likes the business that you're going to buy, typically, like I said, bankers and accountants are very, very often the people who want to do this. But if somebody's interested, so let's say that we're buying a real estate brokerage. So if we're buying the real estate brokerage and we know somebody else who says, man, I know what you guys are going to do with that. It's going to be amazing. I would love to invest in that. You can say, well, you can't really invest in this, but you're a realtor and you're in a territory that we're not in. Would you be interested in opening an office that's basically the same brand, only in that territory? And if they say yes, then you can craft an agreement to allow them to invest money to buy the right to do the office in that jurisdiction or in that territory or that city or that vertical if it's a different vertical or that country, right? But not where you are. And then you charge them for that, and then they pay you in advance for that right, and then you use that money to pay your seller. Jay Abraham talked on our interview that we did with him last week about a car deal that he did where he had a client that was able to acquire a Porsche dealership, and he was able to acquire it because he cut the deal, and then he had to raise a certain amount of money. And what he did was he pre-sold lifetime demo accounts to third-party investors, so people that wanted to be able to drive a different Porsche every year. And so he just gave them, I think the guy sold it for $100,000 a piece for like 10 people or 12 people or however many people he needed to get to the $1 million odd that he needed for the down payment in that deal. And so he was able to do that by taking the assets of the company that the company had and having the use of those assets, not giving them away. So he didn't lose them, just the use of them to third parties who were willing to pay for the right to use those things. So I always think about that deal in terms of creativity, because is there something that I've got in the business that other people would like to use that they would pay a certain amount for, a significant amount for, and I don't lose the asset. I get to have it back. So that's kind of a cool thing to think of too. You can also ask the business broker, if you've got a business broker in the deal or an investment banker, to make a loan of their commission towards the down payment to make the deal happen. They're very incentivized to do this because they are going to close the deal. It's like, I'll close the deal, but you've got to loan me your commission amount back to apply to the purchase price for 90 days, right? So they wait 90 days longer for their commission, or they lose the deal and it takes them a year to sell the thing. You can also have them come in as an investor. And a lot of business brokers, the smarter ones, they use this as an opportunity, just like real estate brokers do, to find deals to invest in. So you just say, hey, how about if you roll your commission in as an investment in the deal. Fractional rights deals are, I mentioned in some of the case studies in the video, and I think even in the challenge, the fractional rights this is another slicing the pie thing. So when you thin slice the company into all the things that it's got, you'll find that that you have an immense amount of flexibility. So a fractional rights deal would be like the deal that we did on the Facebook group with a coaching company to provide the ability to get funding to buy the Facebook group. What we did was we said, okay, we have all the rights right now to do anything we want with this group that Mark Zuckerberg will allow us to do. So we are only in this really to get people who will be real estate agents for our brokerage. So we don't have a coaching program. So why don't we sell the rights to the coaching program to do coaching for these people to somebody else for a certain amount of money to finance the acquisition? So what you can do is you can say, if there's someone else who would like to access the audience, then and then I'm willing to sell fractional rights permanently or for some period of time to that party who's willing to pay a certain amount to have access to that. So that's kind of a cool thing that you can do. A less severe option of that would be to do a sponsorship. You can do a post-dated check. Post-dated check is super easy. That's the ultimate deferred down payment to me. Is just like, tell you what, at closing, I'll give you a check dated 30 days from now, 60 days from now, 90 days from now, that you can deposit then for the amount of the down payment. Let's close it now. I'm giving you this little piece of paper that you can go and it's good as cash. Remember Dumb and Dumber? Those are better than cash. You can take that and deposit it 30, 60 days, 90 days from now. You could also ask a vendor to co-sign a loan. So if you've got a person who's selling or a company that's selling to the company and you need to get a loan to finance the acquisition, you just have that third-party vendor sign on the loan as a co-signer to give you the extra credit you need to get the loan. Why would they do that? Because they would like to continue to have your business. Maybe you agree to keep them as a vendor for 12 months or something like 2 years or whatever. You can go to a money broker. I haven't. We didn't do the interview with Brad Bazar yet, did we? Okay, so will you set that up so maybe next week we could do that?
Yep, cool. I'll work on that right now.
Okay, so money brokers are third parties that actually will go out and find the money that you need to do your deal for you. And they typically charge a fee of about 5% and in the neighborhood of 12 or so grand to do the things that they do. They will help prepare the document, prepare it's really like what you're paying them for is not so much to raise the money. They'll charge typically some piece of equity in your company for the raising the money, but they'll also typically charge a fee because they're going to put together your investment kit, your investor relations package, all the systems and procedures for doing that. So those guys are good to work with for getting third-party investors when you don't have an investor network, especially when you're getting started. Now, keep in mind, there's no guarantee that they will raise the money. They can't tell you whether your offer is going to be appealing or not for sure. They certainly don't take your money to do a losing thing because they're not making their money off the cash they charge. They make their money off of having the interest in the company. The DDP we talked about, that's just the deferred down payment. Leveraged buyout is when you have the debt, it's when you use debt on the company, typically in excess of the value of the assets of the company to acquire the company. It's a very complicated deal, but a friend of mine, Carl Allen, who also sells a program on how to buy companies, he's with Agora, and he's done just dozens and dozens and dozens of those deals. Used to work for a big Wall Street company. I did a bunch of leverage buyouts in the 80s. As well. They are returning in popularity, but they're usually more appropriate for larger deals than we would do here. And a management buyout is where management is acquiring the company. And this is something that you could coordinate if you go to a company and the seller owner wants to exit, and typically that's a founder, but there are several people that are interested that are working in the company. It's kind of like an integrator investment, only you get a group of those integrators and they collectively go to the founder and say, hey, we've put together a group and we're ready to buy it out. So you could facilitate that and participate in the equity, or you could acquire it and then sit in the middle of it and then go to the management and arrange for a buyout. Slips are just being sure that it's a self-liquidating payment. So just you want to be sure that whatever all of this strategy that you put together ends up being, that the company can pay the payments on the whole structure. So every deal is ideally a self-liquidating payment deal. Private placement memorandum we talked about, and that's where you're just raising money, and the staggered tranche PPM. Again, listen to the call with Jillian Doty. Angel investors, pretty straightforward. There are angel investor networks, so you can simply go to them. You guys have several lists of them, which I think, Deanna, are those posted now in their portals yet?
Which one? I'm sorry.
The 5,690 different sources.
They were being posted this morning. She was getting them uploaded at like 9 a.m. this morning. Yeah, okay. So they should be up by now. Yes.
Okay, great. You've got straight merger, where you're merging the target company into your company for stock. So we're in the process of doing 2 of these deals right now. So this is where you have an existing company, your SPV, that let's say you've already done a deal with. Ideally, like to do a merger, typically you start with a company in place. So an operating company. So you've got your SPV and you do your first deal. Now you've got a platform company. So then you have another company that does something that you want to do. For example, we've got, I don't want to say what it is because we're in the middle of it, but we at one of our companies, there's a marketing thing there's an email marketing thing that we find to be very effective. And so we're acquiring a couple more companies that are doing this particular email marketing thing. And so we bring them into the company and we give them shares in our existing SPV, which has an operating company inside it. And in exchange for the stock in our company, or the equity in our company, if it's not a corporation, the people who are coming in bring either their company or their assets. So you're using the currency that you're using is really cool because it's the currency of the stock, which you control. So you get to use this self-created asset to acquire other companies. You can also do straight merger for stock plus cash. This would be where you're offering them stock and some cash. And keep in mind, the cash you can offer them can come from all of these sources that we've been talking about today and the last time we talked, and we're going to go through the last part of them on Tuesday. You can do the same thing where you're merging the target company into your SPV and adding assets in as well. You can do these are SPVs, sorry, special purpose vehicle. Typing too fast. Not to confuse you, you're gonna be like, what the heck is an SVP? It's a super secret thing. The asset merger, you're merging the target company into your company and adding assets. The equity merger, you're merging the target company into yours and adding additional stock or equity. You can do a straight partial acquisition. This is just where you're acquiring part of the seller's business. So and I put these things in here because we forget, right? It's like, I can't put together a deal that comes up with enough money to acquire this $3 million business because I can only come up with 1.8 million when I do the deal soft stuff, right? Well, cool. 1.8 million happens to be 60% of 3 million. So buy 60% of the company, right? So it's just like having this stuff here helps you think about what are your fallback positions. You can do a 2-step partial acquisition. So this is where you acquire part now and then you get an option to acquire the rest. And we do that pretty frequently, and we have that done to us, or we agree to do that when we're selling companies very frequently as well. So a company, you might buy 50 or 60% of the company now and then have an option to acquire the rest later. You can do roll-ins. So roll-ins are just when you're going out in an industry as a strategy and you're saying, I want to acquire, Neil Patel did a good job of this, I want to acquire all of the SEO sites that rank, all the sites about SEO that rank in the search engines. I want to acquire that group, and I'm going to roll them all in to one company. And you can pay cash or stock to the people who you're acquiring there. Partial option to acquire from sellers. So that's just the option to acquire part. So maybe you don't do any transaction now, but you get an option to acquire part of the company, or you get an option to acquire all of the company. And it gives you time to put together the financing. You can do a baseline deal. The baseline deal we talked about is where you're looking at a profitable company and you say, okay, look, I'm not interested in taking anything away from you, but I am going to add value. So let's go forward, and you'll get to keep what you're making right now. So let's baseline this deal at, let's say they're making $60,000 a year in profit. We're going to baseline the deal at $60,000 a year right now. And as I come in and do the things that I do, we're going to split however you want to, most typically 50-50. We're going to split 50-50 the additional profits of the company. That's a straight baseline deal. Now you can do also baseline with option, which I didn't put in here, which I probably should. Let's do straight baseline and then baseline with option. So the baseline with option, which is the way we usually, it's the way we always try to do these deals and the way we usually do them, is that you say what I just said. Okay, don't want any of your profits, so it's making 60,000. You keep the 60,000. We split anything else that I'm able to add or that the business is able to add when I come in, 50-50. But when the profits have increased 3 times from what they are right now, so from 60,000 they go to 60,000 times 3, 180,000. Then I have an option that we own the company 50-50. So there's no more baseline after that. Now, so it's a disappearing baseline effectively, right? And the baseline disappears, which is probably the better, let's say disappearing baseline with option. How about that? So the reason that that's good is it incentivizes you to have something that you're working towards, and the seller's still way ahead because the seller, if the business is now making 180 instead of 60, and you divide that by 2, then the seller's now making 90. So they've increased their profit share by 50%. Okay, and then you just go on for there. So that's definitely the way. 134. That's definitely the way to go about doing a baseline deal. You can use a HELOC, a home equity line of credit. That's pretty self-explanatory. If you have securities, you can also go to your broker and say, I'd like a margin loan against those securities. So they'll give you cash against those. And if there's equity in the business, if there's real estate in the business, then it might be possible to get a loan against that property, like if it's a real estate business that has homes. Also, if the business owns securities, you could get a margin loan against the securities the business has. Adam did a pretty cool deal where he acquired the gaming company that he talks about, and with it he acquired 4 offices, only one of which was being used by the seller. And so he was able to sublease space to a third party. You can also sublease space back to the seller. So if the seller wants to do something else and has a big enough property, like we've acquired businesses where they were like the seller had a couple of different businesses going on in one building, and so we would acquire the whole company, but then sublease space back to the seller to do the thing that they were doing. So that's something that that can be pretty cool too. The earnout, Grant and I talked about pretty extensively on the on the 2 calls that we did about stock and asset purchase agreements. That's effectively where you agree upon a formula to pay the seller part of the purchase price in the future based on the performance of the business. And that can be any formula that you can imagine. So I won't go through all the different iterations. And the only thing I would add to that is that you probably want to cap the earnout at some point. And we impose caps when we do earnouts, and we accept caps when we sell and have an earnout that's going to pay us additional money. So earnouts are a great way when you can't agree on the price because the seller says, yeah, but it's going to do this in the future, and you're like, yeah, but it hasn't to date, so we don't think it is. How about we do this? In the event that it does what you say it's going to do, we're happy to pay you additional money then. What's awesome about that is if the business does that, yay, you won. You're happy to pay them some extra money. And B, it's awesome because you don't have to pay that portion of the price now. You're deferring it to the future. And if the business actually does perform that way, then you have extra money to pay the seller. So it's win-win-win all around there. Love earnouts. Tollgate. So Bob Serling, friend of mine here in San Diego, teaches courses on toll gates. And this is where you're middling the connection of a buyer and seller. He does it for joint venture deals. I do it for acquiring companies. So this is, you're basically connecting the buyer and seller and effectively getting a fee for that and choosing to get paid your fee in equity. So you're basically acting as a deal facilitator, and this is called a success fee in the industry. So you're the toll gate. Everybody has to pay you. Seller has to pay you something to be connected to the buyer. Buyer has to pay you something to get connected to the seller. Why would a buyer pay a fee? Because there aren't enough good deals. Why would a seller pay a fee? Because they want to sell their business. Okay. And then opportunity zone financing. I should put that up there with opportunity zone. There are special financing deals that are available for businesses in the United States that are in certain opportunity zones. And there are counterparts throughout the world. These are basically just special financing deals that are made available to businesses because the government is trying to incentivize investment in a particular area of town or a particular region of the country. And then, and this one I need to take out because I already have that. Okay, so I'm gonna stop here at 140 because that's 140 different ways that we've gone through to pre-strategize, pre-closing strategies. So what we'll do when we get together on Tuesday is we will go through get down here, there we go. We'll go through these, which can kind of be used at either of the two stages. There's I think 10 of those. And then the last few are the things that you do after the deal. And I'll get through as many of those as I can. I promised you 159 of them. I have more since then, so I'll get through as many of those as I can on Tuesday. But that's a lot of stuff. I know it can be overwhelming, but I wanted to be sure that we covered all of it. So I'm gonna be brave now and ask Deanna if we have any questions. We can do about a half an hour of questions if we have that many questions.
We do have a couple. And just to verify, I did look at this. The database will be uploaded in their Kajabi within the hour. She was a little behind. So don't worry if you looked and it's not there, it's coming. So,
okay. Now.
Yeah. Okay. Let's see here. Any other questions? I see a lot of you guys have been great in here as far as really answering each other's questions, so that's good. Sylvester's asking, would this be considered business brokerage tollgate?
I guess because these are in context.
They're asking if when you were talking.
Yeah. So yes, it basically would, where you are acting. I don't want to say you're acting as a business broker because that would probably require a license. But when you're acting as a principal for your own account, you should be okay. Thank you, Kathy. I'm just going to read through these quick, D, because there's not that many of them.
Right.
Oh, that's great. I'm glad you guys like the software. It's super, super fun. And I'm really happy to get to share that with you. It wasn't something I thought we would have time to do, but our software dev team, which we acquired in a no money deal, is really doing a great job on it. So that's going to be fun. The entire list, Roy, is not anywhere yet because it is in the video and it is in the slides. The 159 things are on one slide where they're all listed in an abbreviated form. This document that I have been reading from is what I am going to post for you, but it is not as completely explained as I want it to be yet. So it will be By the middle of next week, it will be posted, come hell or high water, but I'm trying to add to it and be sure that I've captured as many of the strategies as possible, and then I've broken them down and explained them enough between the videos that I'm doing and the list so that you guys understand everything.
Mike Pavlich had a question, Roland. He said, what are the good barter exchanges that you have found that are national and international?
I'd have to go and find a list, but you can just Google them. Wherever you are, there's definitely going to be groups. Yeah, so the document that it describes everything, Jack, is this one that I've been reading from. I'm trying to make it, because it's so much stuff. I'm just trying to figure out how to organize it as best as possible before I publish it. But I will get it to you next week for sure. Gene, I'm confused about third party. They get equity or you do. If they get it, why is it good for you other than getting a part of the price? How do you get your equity? I might need another cup of coffee. Gene, you want to pull Gene up real quick and I can answer that just so I can be sure I have
Gene, go ahead. You should be able to unmute now.
So actually, and the chat has scrolled down. Somebody else answered it for me live.
Great.
And so I got it and I got my coffee.
You got both those things. I love it. I got my tea. That gets me. I don't think it's got enough caffeine though. I'll have to find something better. But as Deanna will tell you, I'm usually texting her at 3:30 in the morning, so we get up pretty early.
We do.
Okay. Brad, did you get number 30? Were you able to get that one? Brad Costanza.
Brad, you can unmute.
Wrap up loan. Okay. You guys, you're right. Deanna said you like my Wuhan China. Bad joke. Yes, it was a bad joke. I know. Let's see. Jasuk, 38, third party collateral hypothecation. What does the third party get in return? What is their motivation for providing collateral piece of equity? Yeah, that's a great question. Jasuk. They either get a fee or they get equity. So that's just like if they're doing a personal guarantee. Was the Ty Crandall call recorded? Yes, it was. You guys are great. Let's see, Alan, on 26 through 29, where you're taking on an equity position in the company, how would you structure the deal where you leverage assets from other SPVs that you own as part of the deal to reduce your purchase price to increase your equity position? Okay, let me see what 26 through 29 were real quick, and then I will happily answer that. Let's see. That was early on. Okay, non-competing. Okay, so these are the non-competing equity splits. Okay, great. So where you're taking an equity position in a company, how would you structure the deal where you leverage assets from other SPVs that you own as part of the deal to reduce your purchase price by or increase your position? Yeah, I mean, it just depends on the deal, Alan. It's you like if you already own different companies and you're coming into a deal, then it's just a Lego thing, right? You're just taking the value that you've got and saying what part of those things that that I've got will be able to reduce the price. What are those things that I have that are assets that I can put in that will reduce the price? So it's if you have more specific, ask me. But that's kind of how that works. Let's see. Kathy, you got all kinds of cool things going. That's great. Thank you, Sherrod. Yep, it's really, really good. Let's see. Yeah, the staggered tranches deal definitely is really, really cool. How do you determine the, yeah, that's a great question. So Nate asked on staggered tranches, how do you determine the new valuation? That's where the valuations are increasing. You set the valuation, right? So as long as you can sell it, it's whatever you say it is. Now you can do that with formulas. So you can say it's a 3.7 multiple because that's what the multiple is in this industry. See, this is what the industry association says this is. Or here are the deal comps from BizComp that I can show you that these companies typically sell for this valuation. What's cool is that even if you're using the same multiple every single time, you're going back to the well after you've added the additional value. So let's say that you need 100K for marketing and you know that that marketing will then allow you, that 100K will have a 9x impact on the company, and now you've done that 100K and you've added 900K to monthly revenue, well, the value of that company is going to be dramatically higher. So even if you apply the same multiple to the company after you've done that first 100K, it's going to be worth a whole lot more money, right? So you can use the same multiple. It's just that you're only taking them, you're taking in, this is really an important distinction with the staggered tranches deal. You're only taking in the amount of money that you need to do the thing that's going to have the biggest impact on the value of the company. So usually that's media, marketing, something like that, right? So what's cool is that then instead of saying, okay, I need to hire 4 people and we're going to buy a manufacturing facility and we're going to do this and this and this, and all that adds up to $2 million, so we're raising $2 million, you don't raise the $2 million now. You don't. Thank you. It's my assistant electronic thing here. So if you take instead of 2 million, you take the 200 or the 100K that's going to get you an increase in media, right? And like in this example, 900, then you just raise the 200 now. You get that integrated and you let the benefit of that be realized before you go and do the other things that aren't going to have that much impact on valuation. So you've only raised the minimum you need to get the maximum valuation, and then you do that a few times and you end up owning a significant part of the company without having any money invested. So that's why that's important. Thank you, Lewis. That's awesome. How do you value the assets that you require with the card for reduction in the business purchase? So let's see, 39. If I can get this document out of the way. Okay, 39. 39, credit card used to buy something the seller wants to, okay, great. So that's where we're using the credit card to buy something the seller wants. How do you value the assets you acquire? You value them at cost. Just value them at cost, whatever you paid for them, Eric. Let's see, Joe, on the staggered tranches deal, how much time generally needs to be between each round in order to get the investment? It doesn't really matter on the time, Joe, it's really the benefit. So again, in the example that I used, you'd want to get that first money in that's going to have the impact, the big impact on the performance of the company. So if you do that, and let's say 3 months as probably a minimum, let 3 months go by. But like if you get it in there and it has an impact immediately, and it's had that impact for 3 months in a row, then I'd be out there, I'd change my valuation and go out looking for money at the new valuation. Alan, on 46, on the Reg D example, if the company has multiple SPVs where the business is thinly sliced, do you strategically roll up the SVPs into a holding company ahead of the private finance, or does it matter? So let me look at 46. Okay, that's a staggered tranche. Okay, so the question then, let me just be sure I get it right. On that example, if the company has multiple SPVs where the business is thinly sliced, do you strategically roll them into a holding company ahead? Yeah, it doesn't really matter. The staggered tranches doesn't have to do with that so much as that you're funding based on it's JIT funding. That's really what I should call that. It's more what it is. It's just-in-time funding. So you may do the funding for the thing that you're going to have the biggest impact on the valuation first, and it doesn't really matter when you do what, as long as you focus on that. Let's see. Are 49 and 50 before ownership? Yes, Kathy, they are. Everything in this screen is before. Lewis told you that. Great. But how can we use inventory before we own it? Yeah. So Kathy, that one is, it's probably the inventory consignment, 49 and 50. Let me just be sure. This thing keeps popping up in front of me. 49 and 50. Yeah, so the way that you do that is that you have a deferred payment. So you agree on 49 and 50. You're agreeing that, and they may have changed because I added some things. So I think, Kathy, that we're talking about the inventory, but can we pull you up just so I can get you to ask me that? Because my numbers changed since I added stuff in.
Kathy's unmuted.
I can't see the list, so I'm not exactly what I'm saying now, but it was something to do with inventory and you were making a deal on it, but it was listed as green. And in my brain, I'm like, you don't own it yet. So how can you make the deal on the inventory?
Yeah, so I'm guessing that what those were numbered properly was when we were talking about inventory consignment. So the way that you do that is that you're making the deal with the seller, not a third party. So you're saying, hey, seller, you own the inventory right now. So what we're going to agree on in the LOI is that you'll consign the inventory to me, and I will pay you for the inventory. We'll reduce the purchase price by that amount. You get it now, right?
Yep, got it.
Okay, great. Cool. Just so, what is merchant account again? The merchant account is the account that allows the business to accept credit cards. That's what a merchant account is. Let's see. And you guys are great. Thank you, Dolores, for answering that. And Sylvester. And Jean. You guys are awesome. I love that. Okay, let's see. Davi, there's a public company. There is a public company with a publicly listed market cap of some $1 million, but essentially they closed their doors, and I have no clue why the market cap is still so high. I think that they would sell me their assets for a few $1,000s. Are they allowed to sell them to me for that? Would the shareholders have a claim because the sell price of the assets are so low? So without giving legal or financial advice, Davi, there shouldn't be, unless there's a secured creditor that has a claim on those assets, or there's some litigation that's pending with that company, or there's some agreement that's written that says that the company won't do that, they should be able to sell them to you. There might be an ordinary course clause that requires a supermajority of the board, meaning that sometimes companies have documents that say that the board, the people in the company, the officers and directors, can't sell all or substantially all of the assets of the company unless certain things happen. And it might be a supermajority, like 3/4 of the board has to approve it, or 100%, or something like that. So, or it might even say the shareholders have to approve. So you want to find out. You want to look at the bylaws of the company and see what is required to sell all or substantially all of the assets, and then get a rep and warranty that there are no creditors that have claims to those assets, and you probably want to do a UCC1 search on those as well. That would be helpful to have somebody like Grant or another attorney do for you, but you can do it yourself. But generally, no, there shouldn't be any problem with them doing that if there's not some specific thing that says they can't. And the market cap, a market cap is just the quoted price times the total number of shares outstanding. So the market cap is really irrelevant in a company like this that isn't actually operating anymore. So it just means that there's some market maker that's still quoting. Like I said, they might only quote that price per share for 100 shares, and then the next price is 18 cents. So that's a really crazy world to get involved in, but it's not unusual in a company like this that it hasn't, maybe trading was suspended, and so it's just sitting at that price, and the market cap looks like it's super high. I wouldn't worry about that at all. Kathy, thank you for answering Jasuk's question. Does the assumption of seller debt essentially void the liability benefits of an asset sale? No, it doesn't, because the big, to me, benefit isn't the liabilities that you know about, Jack, it's the liabilities that you don't know about. So you're assuming specific liabilities in an asset sale. That doesn't obviate the benefits of, I didn't know about that sexual harassment claim. I didn't know there were this many other equity holders. I didn't know there was an option agreement with that person. Dovey, no, there's not a minimum price you need to value the assets at. Alan runs 4-day cash machine. Yeah, 4-day cash machine is great. Great. In what circumstances would the seller agree to defer the closing on the business? Won't they feel threatened that the purchase will take over clients? Yeah, if they're motivated, Sherrod, that's the key. you got to have a motivated seller. So if they're motivated, it's particularly these businesses that are closing down, it's like, what are you going to do? So we close it down next month instead of this month? I mean, that's not a hard one. Yogi, let's see, they could have taken out the cash before going for the sale. What can be done with that? Well, if they took the cash out before going for the sale, then you probably won't buy it, or you will say you need to put that back. I mean, that is the working capital adjustment dilemma, is how much money should go with the company. So if there's not enough to run it, then there's going to be a dramatic discount on the purchase price equal to the amount they should put back. So that would be probably the easiest way to resolve that, Yogi, would be that if they took out too much cash so that after the working capital adjustment, the company doesn't have enough to operate, then the amount in excess that they took out would reduce the purchase price by the amount of the excess. Wondering about the delay of the closing of the business, and yet we want to own and start running it. That's puzzling me. How do we take over the books, banks without closing docs or delayed docs? It's really just in the contracts, Jody. So it's all of this green stuff goes into the contract before you close. So it goes into the LOI so you know what the deal is, but you're not going to generally be able to take over the books until the closing happens, unless you have an agreement and a motivated seller that allows you to do that. So why would someone allow you to do that? They would allow you to do that because you're saying, basically, this is the only way I'm going to buy your company, and they want to sell the company, and they're a motivated seller. Let's see. Where could you review, Brian, the 9 reasons they're motivated? It's in the challenge, and also in the first set of videos that we released. Let's see, SBA 7A loans. Mike, you have an approved lender or broker you recommend? Yes, I do. We recommend Ty Crandall. Good. Sharon, that's great. Yeah, that's really, really super smart. Yeah, Kathy, they did extend the 8 weeks dramatically, which is great because we were only at about 800 of our 1.1 million. Let's see. Awesome. Okay, you guys, yep, 24 weeks. Okay. Great. Just looking through here. I love you guys answering everybody's questions. It's really, really great. Okay, I think. Yeah, so hey, Deanna, where are all of the schedules posted so they can find those calls easily?
Oh, they have them in their emails from me daily, and they're also in Facebook group. At the very top, it's always pinned as an announcement, which they see that. And it's also in their shared doc where we share the entire calendar for their 8 weeks of training.
Very cool.
So
Marty says you've got some toll gate deals right now with members on Epic. I'd love to hear about those, Marty. Maybe you could chat with Deanna about it, and we could do a call so you could share that so everybody could learn. That would be super cool. You generally don't need a license for tollgate deals, Sylvester, but you want to be sure you're not running afoul of any rules about business licenses. So if you need to, talk to an attorney. Thank you, Russell. Appreciate that. You're glad there isn't a test, Gene? That's good. Let's see. Can you sell the asset? Okay, David, owner carry secured by the company's assets. Can you sell the assets post-closing or restricted by the pledge? That depends, David, but typically there wouldn't be a restriction against selling the assets after the close. There would just be, you would just have to pay the proceeds or some portion of them to the creditor that had the loan, right? So they don't typically say you can't sell them. It's just they have a claim on them. So if you sell assets for $50,000 that have a $30,000 claim, secured security interest in it, then $30,000 would go on sale to whoever had that security interest to release that, because the buyer won't buy the assets while there's a security interest. They're going to want that released. The person who has the creditor that has the security interest releases the security interest at closing by signing, I think it's a UCC2, and then the person, you keep the 20K profit, the creditor takes the 30, and the person gets free and clear assets.
Awesome.
Let's see.
I think that's good, right? Let's see.
I think it is.
Awesome. And just a FYI, I just got notice that everyone, your database is in your Kajabi portal right now. It is live.
Fantastic. All right, everybody. I know that's a ton of stuff, but we're getting there. So Tuesday we'll finish up this list, and like I said, I'll continue to find the best way to do it. Worst case, you'll get this thing that I've been reading from the last few calls. But I'm hoping that I will be able to have it in a way to organize it a little bit better for you. I want it to be a checklist, but I want you to not have to go through 200 and some things every time you do a deal. I know you will learn, and the things that are in the deal software right now, the Excel sheet that you got, are the most common. But it's good, as you can see. It's just good to know your fallback positions. So that's everything for now. Thank you guys for being on the call, and I'll see you on Tuesday. Thank you.
I'll see you guys on the very next link. We'll get there live right now. Bye, guys.